Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Brianna Valesky, and we have a hedge fund guy on the line, Joshua Van Dress. He is CIO of Able Capital Management. How you doing this morning, Josh?
I'm all right, and yourself?
We're doing pretty good. Could you give us a little bit of your background in the markets and how you ended up starting Able Capital Management?
Sure. I was a stockbroker, 763, for about 16, 17 years, just on Wall Street, peddling just like everybody else. And I really got tired of the whole call up Mr. Jones looking to generate a commission, praying that the stocks work out, when in fact 9 out of 10 times they didn't. And I just got real tired of the Wall Street mentality of make a book, spend your life doing it, just to burn it up and do it all over again. And I started to go to a lot of Bloomberg seminars, and I heard probably about 9 years ago a gentleman speaking about different divergences and convergences, and for some odd reason those words generated with me very, very well. So I started to look further into the world of quote-unquote pair trading, buying one stock long, shorting another stock, waiting for the anomalies to happen and come back and forth and such. So I started up while with my other company, which was National, where I was licensed with 763. I started up a quasi hedge fund, and because of the rules, with the SEC, it's very difficult to do it at a BD. So I decided to go off on my own with one other partner and start up Able Capital Management. And we are strictly a market neutral hedge fund in the purest sense of the word. There are very few of us left. So that is exactly how Able Capital got started, and roughly so far, roughly 5 months, it's been good.
Oh, kind of new. So how do you stay market neutral? Obviously, you're doing pairs there. Do you use the futures market to lay off positions, or how do you maintain your neutrality?
Well, the first thing that I noticed about stocks from having so many years of, real world experience, and I guess I should probably clarify that. If you work at a Merrill Lynch or a Wells Fargo as a broker coming up, basically your job is to sell. They'll have a money manager, and that money manager picks the stocks, right? It's not really the broker per se. Well, for 16 years, I was the broker that picked the stocks, and I lived and died by my picks. With pair trading and market neutral, what you're doing is you are picking stocks in the same sector. So let's take Ford and GM as a perfect example. And you may say to me, well, Josh, I want to buy GM. And I'll say, well, that's great, Joel, but since we really don't know what's going on in the market, and the market is so volatile, we're going to go ahead and short the opposite company, whether that be Ford or whatever the case may be. And we will use that exactly. If there was 25 grand going into Ford, well, then there would be 25 grand going into GM. So thus the key word of market neutrality. The big difference, a lot of firms, as you guys, I'm sure you've had hedge funds on in the past, a lot of them start out that way, but as you can see, they certainly don't finish off that way. Perfect example, Paulson Investments. I believe they were down 39% 2014. Don't quote me exactly on that number, but I think I'm pretty close. And the main reason is people meaning hedge funds, they're starting to go down this trough where it's no longer market neutrality. They're literally trying to change. Perfect example, you guys, your readers, your viewers are, I'm sure, very familiar with, J.C. Penney, Sony, where Third Point Capital come in and buy 17% of the company and basically tell them what to do. And the days of the pure form, which I consider myself to be, there.
Looks like we just lost him.
Let me double check on that. Tell us what's going on in the markets right now, Joel.
Okay. All right. S&P futures are trading up 10 points here at 36.50. Just had a dip down. That was real quick just before Dennis got off the line here. We dipped to 2030. Actually, yep, 2030 even. That was the quick low we just hit. I'll just keep an eye on 36 and a quarter here. We're going to do a lot of dancing around on that level. That's mid-range on the day here. Are we getting Joshua back?
We're certainly trying.
Okay. If there's any issues that you folks want to take a look at here, well, we're bringing back Joshua Dress here on the line. We will hold on here for one. Joshua,
I am here.
Sorry about that. The Gremlins got us. Let's just.
They did.
They did. The Gremlins are getting us. So, okay, pair trading. I've been around some people. They've done, some pretty heavy pair trading, keeping the positions on for quite some time. One thing that I've noticed about it is that, you seldom, put a pair on and like immediately goes your way. Do you layer into these things? If you're going, like, let's say I come to you with 50 grand, I want to go long GM vis-a-vis, a pair with Ford. Do you have like a level that you wait for and try and
It's funny that you mentioned that. To my knowledge, we at Able Capital, I have developed a systematic, layered approach to pairs trading with 6 different algorithms that I've created for my investors. If you look at a stock exactly like you mentioned, a pair, you buy in, next thing you know, boom, you're down 20% immediately. And it really is a stickler. Clients don't like it for obvious reasons. They do not feel safe, and the whole adage of, well, we are a hedge fund, well, that just went right out the window with the down 20% in one position idea. So basically what we do is we're smart enough to know that we don't know everything. And if you just do the math, there's a 33 and a third chance you're going to be right, break even, or lose. That's 100%, right? So when you do it with the pairs, I go in with either 3 to 4 differentiating pairs of differentiating capital while always remaining market neutral. So yes, I do use layers, and I live and die by them.
And you take the pairs off automatically together. You don't try and leg out of stuff.
No, sir. No, sir. We have. I don't know how many are familiar, and if they're not, they can always go to my site or YouTube, Able Capital Management, NYC.com, and there's a little bit of a blurb on there how I do it. But basically, in a nutshell, the problem with the markets today, in my opinion, is if you look at Caterpillar, especially so far in 2015, these are not companies that you're going to make 25% in any longer within a short period of time. If you're a Warren Buffett, sure you will. If you're the General Joe Schmo, you're not going to. So what I do is with the first layer, when I look at a pair, I look at it from a fundamental and a technical basis. I have 16 different what-ifs, so 16 different algorithms on the fundamental side, approximately 17 different algorithms on the technical side. So there's a lot involved between the two, but to get to the gist of your answer, the first layer will always be the investor pair. That will always be, we expect 8% out of the pair, layer 1 will stay on. If layer 2 decides to get put on, and we can make 3 to 4% on that going back and forth, then why not? And that's exactly what we do. So we will not put 3 to 4 layers on and in a pyramid and wait until that expected price happens. We will go in and, trade on the second, third, fourth, fifth layer to make our production for the fund because that's what they expect is money. So that's what we do is make them money on those pairs, on those layers, wait for the investment to mature on the first layer.
What's your time horizon on these usually?
It depends. We have three separate. I run three separate algos that are my main algos, which are one is like as an example RSI. So for your relative strength ones, my time horizons, because those generally tend to be, as most investors already know, trending companies. So those will tend to be anywhere between 60 to 90 days at the most. On the trading pairs, I will use a 20 to 30-day pattern on those with a little bit of secret sauce that we're not going to get too much into. But
Give that away.
nonetheless, it's worked out well for us.
And do you wait to get to certain areas and just throw two market orders in? Or are you very precise going there with defined limits and make sure you get your price?
Well, things that I feel comfortable telling investors are that when you invest in the stock market, it's very, very difficult nowadays for a broker, a money manager, to tell their investors, look, you're going to have peace of mind. Meaning that when you wake up, most of your money is still going to be there, if not more. And every single one of my algos are hardwired with a 1.5 to 2% stop. Every one of them, regardless.
Okay.
Now, that's not to say that you're going to wake up in the morning and unfortunately you can't catch something like eBay laying off a lot of people because they don't know what's going on right now. But generally speaking, we're currently running with a 68% win rate. If you do the math, at 1.5% stop, if we were to only make an average of 1% on every win, that's 26% a year. I don't know too many investors that would be upset with that, Joel.
No, not at all. Do you let's say someone wants to do something in Apple. I mean, how do you find a pair for Apple?
Let me make sure we still got him.
I'm here.
There we go.
Okay, I asked you about Apple. Do you have a pair for that, or is that something that is really hard?
I do.
Okay, what do you?
I do actually. It's funny that you mentioned that. I like to pair Apple with my favorite one to pair it with right now is Microsoft.
Really?
Microsoft has such a large float. There's really not a tremendous amount of news that are going to wake people up and make them shudder in their chairs about Microsoft. So it's a relatively safe position to be short in while you can go ahead and obviously that's a perfect example of a beta pair. I do utilize that as a beta pair instead of just market neutral. So, but yes, I'll use that. Sometimes I'll use the IWM. It just depends. But yeah, I do trade the Apples of the world like that.
Okay, so so basically anybody can come to you with like any stock and you'll be able to find a pair. You don't have a group of let's say 20 pairs that people are tied to. Like let's say, let me see if I can throw another. Like what would you pair Google with?
Google, to be honest, I do not pair. And the only reason that I do not pair Google is they are now starting to become.
Okay, we seem to be having a little bit of Skype problems here. Hopefully we can get him back here.
Yeah, it says he's still there, so let's
He's
give him just a second because we lost him. Josh, you still there?
Nope. Okay. All right. Hopefully he'll pop back on here. S&P futures trading up 12 points at 20.3850 here in today's session. All over the map here with this ECB news.
Yep.
After that pop down to 2030, we got up to 2042.
Okay.
Now, sorry, Josh. I don't know.
All right.
I don't know what's going on, but before we let you go, just I mean, I know you're a pretty market neutral guy here. A lot of volatility with the ECB and stuff. Just last thing, why would someone come to you and want to do pair trading as opposed to just buying everything because the market always goes up?
Stability in the market doesn't always go up. If you look at, let's take, I'm 42. My mother worked her entire life for her IRA, and I'm sure there's plenty of your listeners that are sitting there and they're shaking their head and they're thinking, yep, that's me. Now they're sitting there after they're retired and they're doing what? They're working again. Why? Because their IRA didn't do what it was supposed to do. There is a very large disconnect between institutional America with educating their investors in how to invest for their retirement and not to invest. So the big takeaway with pair trading is it's much safer than that of your average retirement account if the hedge fund that's doing the pair trading knows what they're doing. In my hedge fund, which again, you can just go to the site and check it out for yourself. It is there is no lockup period where there are a lot of hedge funds require a year minimum. There is dual cash management, meaning I can't take the money out and basically pull a Bernie Madoff. And most importantly, they have the peace of mind of knowing, look, if the guy wins 67% of the time, then I'm going to make roughly X amount a year. So that's why you can control a pair trade. You cannot control eBay coming out and laying off 6,000 workers, if that makes sense.
Okay, one final question. Do the clearing firms give you a break as far as the margining goes?
Okay, I beg your pardon. I didn't hear the whole question.
I was just asking about the margin. Because you're doing pairs, do you get a break on, the margining if you're long and you're short the stocks, one vis-a-vis the other? Do you get any help from the clearing firms on that, or they charge you a haircut?
Okay, are you asking me about margin?
Yes.
Oh, okay, perfect. So basically what we do, again, it's just breaking up. Basically what we do is we trade, we're allowed to trade with 18-to-1 leverage. Obviously, we do not do that as a practice. We go 5-to-1 leverage. And the reason is the way my algorithms are based around is to no matter what, with a 1.5% stop to 1.25% stop, depending, is to no matter what, you want to make sure that you make the investors money. The investors make money, you make money. So yes, we do utilize margin, but it's only 5-to-1. And the debt that I'm paying right now on that margin is usually paid off within the second layer of each pair trade. So therefore, the investor does not see the interest charges that they normally would at a Schwab or a Merrill. Choose your pick, basically. The commissions are relatively low, 0.3 of a penny, just to give you an idea. So, and there are no ticket charges. So investors feel very comfort. They feel a lot of comfort with that. A lot of comfort.
Okay, we've been on the line here with Joshua Van Dress, CEO of Able Capital Management, joining us here on Benzinga Pre-Market Prep. Thanks a lot, Joshua. We'll talk to you again soon.
All right. Well, have a great day, and hope to hear from you again. And let's hope for a little. Hopefully, we won't have such a crazy market. And I wish you the best of luck.
Okay. Thank you, Joshua.